They tell us prices rise because of inflation, because of supply chains, because of energy costs, because the market decided. But here's the uncomfortable truth. Most people never hear. In many industries, prices don't rise by accident. They're guided, coordinated, quietly controlled. Not by governments, not by central banks, but by corporations that have learned something far more powerful than monopoly. They've learned how to raise prices together without ever saying the word together. And once you see how it works, you'll never look at a price tag the same way again. Right now, across groceries, housing, healthcare, airlines, tech subscriptions, and even fast food, people are asking the same question. Why is everything expensive at the same time? It's tempting to blame chaos, pandemics, wars, inflation. But chaos doesn't move with this kind of precision. Prices don't just rise. They rise in sync. Within weeks, sometimes days, across competitors who are supposed to be fighting each other. And when costs fall, prices don't follow. That gap between what companies pay and what you pay is where the real story begins. This matters now because we're entering an era where price control no longer requires illegal meetings, secret phone calls, or smoky boardrooms. It only requires math, data, and a shared understanding of incentives. And that system is already built. To understand how corporations quietly control prices, you have to let go of the version of capitalism most people were taught. The simple story says, companies compete. Competition drives prices down. Consumers win. That story only works when there are many players, imperfect information, and real fear of being undercut. This has already happened in e-commerce, airline tickets, ride-sharing, hotels, and digital advertising. And because no human explicitly agrees to anything, regulators struggle to prove wrongdoing. From the outside, it looks like competition. From the inside, it feels like coordination without communication. The third mechanism is cost storytelling. This is where corporations shape the narrative around prices. When companies raise prices, they don't say, "We can." They say, "We have to." They blame labor, fuel, supply chains, regulation. Sometimes those costs are real. Often they're exaggerated. Sometimes they've already fallen. But the story lingers. Here's the key detail. Prices go up immediately when costs rise, but they rarely come down when costs fall. That's not economics. That's psychology. Once consumers anchor to a higher price, lowering it feels like lost revenue. Executives even have a term for this. Price discipline. It means resisting the urge to compete on price, even when costs allow it. Investors love price discipline. Analysts reward it. Stock prices rise when companies show they can hold the line. So, who pressures companies to keep prices high? Not governments. Not regulators. Shareholders. Public companies are punished for starting price wars. They're rewarded for stability. This creates a quiet alignment across entire industries. No one says, "Let's all raise prices everyone size. Let's protect margins." The outcome is the same. The fourth mechanism is capacity control. This one rarely gets attention, but it's incredibly powerful. Instead of manipulating prices directly, companies limit supply. Airlines reduce seat availability. Oil producers slow drilling. Rental platforms restrict listings. Food companies shut down inefficient plants. When supply is tight, prices rise naturally. And because companies frame these decisions as efficiency or discipline, they're praised for them. During periods of high demand, corporations don't rush to expand capacity like they used to, because expansion risks future oversupply. Oversupply leads to price competition. Price competition destroys margins. So they grow slowly, carefully, just enough to keep prices elevated. From the consumer's perspective, it feels like scarcity. From the corporate perspective, it's strategy. Now comes the uncomfortable math. Let's say a company's costs rise by 5%. In a competitive market, prices might rise 5%. In today's markets, prices often rise 10, 15, even 20%. Why? Because price increases are opportunities. If consumers are already expecting higher prices, companies push a little further. Executives call this pricing power. Pricing power is the ability to raise prices without losing customers.
And over the last decade,
Pricing power has become the most celebrated trait in corporate America. Listen to earnings calls. Executives brag about it openly. We successfully passed costs on to consumers. Our customers showed resilience. We saw minimal demand destruction. Translated into plain language, people had no choice. Healthcare companies do this relentlessly. If you need the product, price sensitivity disappears. The same logic now applies to housing, education, software, and even food. When everything is essential, everything becomes it's the result of decades of consolidation and dependency. Now, compare this reality to the public hype. We're told markets are competitive, that innovation keeps prices low, that consumers can always choose alternatives. But alternatives don't matter if they're priced the same. Competition doesn't help if everyone follows the same playbook. And innovation often becomes an excuse to raise prices further. Think about subscription models. Once upon a time, you bought a product once. Now, you rent it forever. Prices don't jump dramatically. They creep $1 more here, $2 there. Just enough that you notice, not enough that you cancel. That's another quiet form of control. Not setting a high price, stretching a low one endlessly. Over time, the total cost far exceeds what the old price ever was. But because the increase is fragmented, resistance never forms. This is why inflation feels different now. It's not just broad, it's sticky. Prices raise fast, they fall slowly. Sometimes never. The system is designed that way. The long-term implications are deeper than higher bills. When prices are controlled quietly, trust erodes silently. People stop believing explanations. They assume manipulation everywhere. They feel squeezed but can't point to a villain. That uncertainty it changes career decisions. It delays families. It reshapes politics. And corporations don't need to coordinate politically to benefit. They just keep doing what the system rewards. Maximize margins. Avoid price wars, signal discipline. This raises a final, uncomfortable question. If corporations can control prices without breaking laws, if algorithms coordinate faster than regulators can react, if investors reward higher prices more than innovation, then what exactly is competition now? Is it real? Or is it a story we keep telling ourselves while prices quietly move in one direction? Because if price control no longer requires collusion, only incentives, then the most powerful force in the economy isn't greed. It's silence. And once a system learns, it can raise prices together without ever speaking. What reason would it ever have to stop?